Hello, friends, and welcome back to Market Shares. I'm your host, Tony Blodgett. And look, if you've been a regular watcher of Market Shares over the years, you know that we drop a new episode every single Friday. But I'm going to let you know that there is going to be probably some inconsistencies in our schedule coming up. Just a lot of things happening that are probably going to create a couple weeks where I'm not able to record. As you maybe heard me talk about, I am in the process of moving. We are going to be relocating from Washington to the Idaho area, the greater Boise area. That's going to happen over the next couple months. It's not going to happen overnight, but we have that going on and some travel related to that. Obviously, with the summer schedule, we have some travel, and then my team is traveling. So our crew here that works in the studio, as well as our videographer team, we have some vacations and stuff coming up. So I thought this was a great time to probably slow down on some of our episodes during the summer. But what you will get instead is probably some of our, best episodes from the past, maybe something that you might have missed over the years. So we'll fill in with a few of those. If there's major, breaking news or something super important, obviously I'll be coming on and putting out a new episode. But just want to warn those of you who are very loyal listeners or watchers of the show that you might see some inconsistency with regular episodes coming out every single Friday. But I do want to do an update here on what's going on with mortgage interest rates and the market. And I want to talk specifically about oil prices and mortgage rates. This is something I've covered multiple times on this podcast, and I've shown graphs in the past that show you how closely tied together mortgage rates and oil usually are. Now, I think it's important to clarify that statement. Look, I don't believe, and it's not true, that mortgage interest rates are directly tied to moves in oil. It just so happens that they always end up in the same spot together eventually, right? So that's people would say, well, that's causation without correlation. Fair enough. But it is an overarching, reality that we see in the market. And it doesn't always happen immediately. And we've seen a few times in the past where oil prices went up or oil prices went down significantly and mortgage rates didn't move with them. I will tell you, it's pretty few situations where that happened, but they do exist because the two are not directly tied together. What they are directly tied to, though, is inflation, right? So we all know that when the price of oil goes up, there is pressure on inflation. I don't think there's any question about that. That would be more of a direct correlation. And the same thing with inflation being tied to mortgage rates. There's a direct correlation there. However, mortgage rates are also based on other factors, and one of which is the labor market. So what's going on right now is if you look at oil prices, and I touched on this just in my last episode, at the peak of this Iran issue, we saw oil touch close to $120 a barrel, close to that, maybe just under, depending on what you're looking at. And as of right now, oil prices are basically back to where they were before the conflict started, like $67, $68, $69 a barrel. So we're kind of back to where we were at the end of February, but rates haven't quite come down yet. Now, a lot of people go, well, Tony, I thought that oil prices and mortgage rates move together. And yeah, I'm not changing my stance on that, okay? But you do have to understand that there was a little bit different circumstances going on in February, and the labor market is a big part of it. So back then, we were talking about weakness in the labor market. Now, I personally still believe that we have some weakness in the labor market, and we just saw that with the most recent BLS jobs report. That was a pretty big miss. But leading up to that, more recent data over the last couple months has shown strength and resilience in the labor market. And so what we have is these Fed members who have been fairly vocal still. Now, I think that that's going to tail off over time because I don't think our new Fed chairman is going to be a huge fan of these Fed members getting on their soapbox and, giving their opinion on what they think is going to happen. I think we'll see less of that. It's not going to go away completely. But we have a number of Fed members. If you look at the dot plot, you see this evidence there, and you just see it in the headlines. They're out there talking about, there's going to have to be more Fed rate hikes. The futures market's still anticipating Fed rate hikes here in 2026 as opposed to future cuts, and just multiple comments from the Fed. So there's just so much turmoil from the Fed. They're very hawkish right now. But I think a lot has changed since these comments were made just 2 weeks ago. The Iran war is essentially over. Now, I say that, and then this morning I hear that, a couple missiles were shot at oil tankers going through the Strait of Hormuz because, they were a little bit off the path that they were supposed to take through the strait there. So, there might be little flare-ups here and there. The market didn't have a significant reaction to that. We'll have to see how that plays out. But look, as long as oil prices stay low, then I believe mortgage rates will get there. I think it's going to take a little bit of time, as it often does. And I never said that it wouldn't. It just might, it might take a little bit of time for it to get there. But what we're seeing right now, based on the last BLS jobs number, is, I think that the overall sentiment is the labor market is stronger than we were thinking. There was talk before that the Feds may have to cut rates simply because of the weakness in the labor market. I think that's subsided, but I also don't think it's strong by any means. That would lead them to have to hike rates. But really, it's been the ongoing inflation talk as we've, come through this massive spike in oil prices. So this next Fed meeting that we have is going to be very interesting to hear what the tone is. Because now that we have, at least a semi-permanent resolution, it appears, to the conflict in Iran, what are these hawkish Fed members going to say? Are they going to change their tune a little bit about their concerns with inflation as a result of oil prices now significantly coming down? Because that's what they've been pointing to over the last couple months as it relates to why they've been so concerned and feel like the Feds may need to hike rates. So, we just had a recent weak jobs number. I think, there's more confidence in the labor market than there was, but it's still not super strong. And I think most people that are forward-looking, including our Fed chairman, Mr. Walsh, understand that AI and the impact of AI is going to bring more productivity and put pressure on the labor market over time. Not too dissimilar to what happened with the advent of the internet and, back in the late 90s. So, we've been down this road before. It's not exactly the same as AI, but, history, doesn't always repeat itself, but it does rhyme, as they say. So I think we have a similar situation coming up there. So I guess my point is, guys, is let's be patient here with mortgage rates. All signs are that they will come down. Sure, of course, I would love to see them come down as quick as they went up. But if you've been in this business as long as I have, there's a reason that they say mortgage rates shoot up like a rocket and come down like a feather. It's just an unfortunate, part of what we deal with. But keep an eye on oil prices. Let's hope that the ongoing, peace treaty there in the Middle East sticks and we don't see any more craziness and oil prices stay low. If that happens, it's going to trickle through and you will see mortgage interest rates come down. I think all of us should be super happy that those mortgage spreads have narrowed, because if they wouldn't have over the last 12 months or so, we would see mortgage interest rates well into the mid to upper sevens right now instead of the mid to upper sixes. So we definitely, had the benefit of that, which also tells us that as rates go down, it would not be unlikely for them to get lower than they were before, as we've continued to see the spread narrow between the 10-year and mortgage-backed securities. So you guys just be patient. There's so many factors that drive interest rates. Some people have criticized me for speaking about oil so heavily, saying, Tony, they're not even like directly related. Like, I know, but go back and look at the charts. I've posted the charts here before. Like, they will end up together in the near future. I have very little doubt about that. It's just we have a few other factors. We get Fed members, we got inflation, we got the job market. All those things need to kind of work themselves out. And I think they will rather quickly, and we'll start seeing a more significant move in interest rates. The nice thing about that is, as I've talked about, you guys, when we see interest rates drop, there is pent-up demand. And so I expect a surge in demand as interest rates start coming down. And it might not be in the next week, it might not be in the next month, but I think it's in the next quarter. I think you start seeing the result. If oil prices stay low, it will be like a magnet. It'll be like gravity. It will pull down those rates over time because that's just the way that it tends to work over time. So you guys, that's my episode for today. Keep in mind, I'm going to probably miss a few episodes. And for those of you that are super loyal watchers and listeners, you might notice that more than others, but I appreciate your commitment to market shares. I've been committed for the last number of years to do an episode every single week. And as I go through this change in life and this season, it's going to be a little more difficult to get in here with the same level of consistency. But we will be back at it as time allows. And once we get through summer, I'm sure we will be rebooting up and I get settled in my new home. We'll be rebooting up our agenda and making sure you guys have consistent updates from the team here at Market Shares. So with that, you guys, enjoy the rest of your day. Thank you for your time and attention, and I'll see you on the next episode. Take care.